Yes,
Please
sir.
go ahead, Akshay.
Now I request HOD of our department to address the gathering.
Yeah, thank you, Akshay. Good afternoon, Raghupati sir. Good afternoon, Ms. Sonam Srivastava. We are from Data Science and Computer Applications at MIT Manipal. And we have a BTech Data Science and MTech Data Science. Along with that, we have MCA course in this department. Thank you for accepting our invitation to be a speaker for this session. Thank you very much. We want to associate with you in all other future endeavors. Thank you. Please go ahead. Thank you.
Alex, thanks a lot. Thank you for.
Yeah, Akshay, you want to introduce Sonam?
Yes, sir. Let me take this opportunity to introduce our speaker for today, Ms. Sonam Srivastava. Sonam is a founder of Wright Research, an India-based robo-advisor where she creates data-driven portfolio out of her deep passion for quant finance. Wright functions as a CBI registered robo-advisor and is among the most popular advisors amongst the millennial investor with more than 30,000 clients and 125 crores plus in assets. Wright Research has delivered 90% plus outperformance over the index in the last 2.5 years. She has 10 plus years of experience in investment research and portfolio management, working on systematic strategies, long short strategies, and algorithmic trading. She started her career in the field with Mumbai based Forefront Capital, which got acquired by Edelweiss. At Edelweiss, she worked as an algorithm designer at Edelweiss's institutional equity broking desk. After that, she worked at HSBC Europe as a quant building factor driven portfolio solutions. Before starting Wright Research, she also worked at Qplum doing portfolio management at AI driven robo advisor. She graduated from IIT Kanpur and has a master's in financial engineering from World Quant University. She is a globally recognized researcher and works as a visiting faculty as AI in Finance Institute, New York, and BSc Institute Limited. With that brief introduction, over to you, Raghu sir, for setting the tone for today's session.
Yeah, so guys, the reason I told you the reason why we have Sonam on the call, and I I am almost double or triple your age or whatever it is, and the variance, as they call it in the portfolio, is too much. So when I tell you something, maybe I'll tell you the same thing but in a different fashion. So Sonam is more closer to your age group, and hats off to her. You know, there's a saying that a bumblebee flies because it does not know it cannot fly. Okay, aerodynamically, it is spherical. It doesn't have the strength to fly. Sonam did not know she was not a computer engineer. Sonam did not know she was not a mathematician. Sonam did not know she was not a finance person. And she has made it to the top. And the best is yet to come. She has just started her journey. And Sonam did not know she was from Bombay or Bangalore, which are supposed to be the tech and finance capital. She is from the beautiful yet laid back city of the Nawabs, where pele up, and a very laid back lifestyle is the norm, not the startup lifestyle. Okay, and I'm really proud to have made her acquaintance, and because I can see that uh, at this young age itself she has achieved so much. Of course, my nazar should not fall on her, but as they say in Hindi, but I think she's destined for bigger things, and we can see bigger things. The reason that I needed all of you to listen to her is, like children, they always say, when at least when we were growing up as kids, my mom used to point out to some kid in the neighborhood and say, "Beta, dekho usne sorry, let me say it in English. He has passed IIT, so you should also be like him." That bhaiya has come first in class. So like that, I think I hold up Sonam as an example of the next generation and what is new India, what is my dream of new India. Welcome, Sonam. Thanks for taking your time. I know that you run a very busy schedule because you yourself code, you yourself do algorithms, you yourself do all this sort of things.
Yeah.
So,
Yeah. No,
welcome, Sonam.
thanks a lot.
I'll just stop
Yeah.
here. And guys, you can have a good conversation with Sonam, which possibly age prevented you having with me. Go ahead.
Okay. So thank you, Raghu, for the introduction. And I'm so happy to, talk to this class of people who are interested in this field. And Akshay and Raghu have given you a good introduction for myself. I'll probably take you through a little bit about, what I do right now. I'll introduce you to what, if you are looking career as a quant analyst, what, you should be looking to do, right? I mean, what are the roles out there? What are the skill sets that you need to build, right? So that is what we will be doing. I am just trying to share my screen.
Upload it, Sonam. There is just near the speaker box, there is a square box with an arrow. Yeah.
Can you see my screen?
Yeah, we can.
All right. So yeah, that is good. So I have a couple of presentations, that I usually use. I will sort of go through them. And what I would really encourage is that, people, if they have any questions, anything you want me to talk more about, please go ahead and ask me those questions, and let us make it more conversational, right? So I'll start off by an introduction to myself, and I'll talk a little bit about a career in quant finance, and then I'll take you through a small presentation on, algorithmic trading in India, what all people do in that space right now, and what all, can be done in the future. So I hope that would be a good plan for this presentation. So I'll start off by talking about myself, right? I I started working in this field of quant finance, algo trading in 2011-12, right? Which was actually uh, just the start of algorithmic trading in India. Algorithmic trading in India legally, right, through regulations, started in 2010 itself. So having started very early in this field, I got to, work on a lot of interesting things, right? But still, when you look at the market in 2012, 13, 14, right, algorithmic trading was a very, very small portion of the market, right? Algorithmic trading was a minority compared to the market. And when you look at the developed market, you will see that algos are the majority, right? Algos comprise of 70 to 80% of the trading in the global market. So I had an opportunity to work with, Indian organizations, seeing that growth and, doing a lot of interesting stuff. I always wanted to work more on, quantitative strategies that are profit generating. So I moved to HSBC and worked on the European desk, and I picked up a lot of experience from the organization that I worked at. And in 2019, I thought that it's an excellent time for us to, to build an organization that is, working purely on the basis of quant, right? So right now, larger organizations, they have a small quant team that sometimes gets a lot of priority, sometimes doesn't. So my idea was that we want to do full quantitative based work, and, really show people in India what all can be done, right, with these methods. And right now, I think is the perfect time for somebody like me to start, because people are becoming more and more trusting of technology, of digital, of, using their phone for transactions, right? So this is an opportunity where we have seen a lot of people who are aware of technology, right? If you look at just right now, you will see a lot of them are from the tech background, right? So they trust technology. So it is a very good place in India to come out with a tech-driven investment product. People like it. We are able to deliver very good performance, which is giving us a lot of boost in terms of traction and growth from the investor community, which is a really motivating factor for us to keep growing. So that has been my journey. As I told you that how I got my break in quant was by studying for the CSA level 1, right, in 2010-11, and I started my journey at Forefront Capital, which was a quantitative hedge fund that I just set up in India, and it was really interesting. That took me to Edelweiss, HSBC, and then I, eventually became an entrepreneur in this field. I've done my master's in financial engineering from Wharton University, which is a very interesting course where they teach you coding with Python as well as financial concepts. They do actually use data science and finance together, whereas various courses that you will go to, they either teach you data science or finance. So doing a mix of this can you always need to know finance when you're doing work in this field, right? So you always need to understand what the products out there, what are the constraints, right? If I'm creating an algorithm, how will it be constrained by the rules and regulations that are out there, right? So that has been one of the things that you need to learn while you are might be excellent in data science. You also need to be aware of the financial aspects of it. So this has been my journey, and what I believe are the core skill sets that you use, that you need for when you want to go into a role in quant finance is obviously you need to know basic programming. You probably don't need to be the best programmer out there. You don't need to be the best programmer, but you need to know the basic, maybe a Python R programming. You need to have a handle of statistics because a lot of this work is statistical based, right? We are all looking at distributions and finding patterns, right? So statistics is a core skill set. Now, as the field is evolving right now, people are looking at application of machine learning, deep learning, and a lot of other things in various problem sets. So that's a good skill set to have. It's not like necessary for a beginner, obviously. You need to. There are various other topics in financial engineering that I've seen your course that you guys are covering, and econometric time series analysis is also a core of this field, right, which you need to have. So these are in terms of technical skill set. This is what you need, and when you look at the financial side, right, you need to have an idea about corporate finance and valuation. What that means is that you need to be able to understand if you are looking at stock market investing or corporate bond investing. You need to understand how to evaluate a particular company by looking at their financials and what are the various events that a company has that will lead to some sort of noise in the market or some sort of price fluctuation, right? So you need to understand all those things. Accounting is a good skill set to have, and also macroeconomics, right? You need to understand on the country level or on the global level, how will the federal rate hike or how will the RBI rate hike affect your portfolio. So obviously for a beginner, these are not something that you need to have. You sort of develop it while you go to your first job. I'm sure when I started my first job, I only had a basic programming knowledge and the statistical knowledge, and I sort of learned various things along the way. But for you to flourish in this field, you need to build this skill set of financial as well as technical knowledge, as per me. And then there are a number of roles where you can go to. There are a lot of analytical roles and forensic accounting roles where people are investigating companies and coming up with insights based on that. There is a lot of data science based roles. There is quant research. There is quantitative trading, where you not only do research but also apply it for your trading. You can do portfolio management, which is construction of a basket of stocks or various other things, which we primarily do. You can do risk management as a quant, right? Because risk is the core or the most important thing in finance, right? If you're doing risk management right, then you can afford to do other things, right? So risk management is a very, very core role. People work at derivative pricing a number of complex derivatives. When you look at the global market, there are a number of complex structures that are out there. So pricing them, structuring them, there are a lot of interesting roles. And then You will always be a quant entrepreneur like me, where you are confident in what you are doing and you want to see this work in the real world. So see, actually for me, when I sort of moved to quant, I was, I did not know what I want to do in life, right? And when I started working on those algorithms and I saw that, my skill set as a data scientist are working here, and I can immediately see a reward, right? In terms of profit from the market, right? So that is a very, very enabling thing. And if you can, do this thing well, then you can look at various roles, or even starting on your own in this particular field. And the mindset is also very, very important in this, because it is a noisy field. It has its set of risks, right? And it has its set of rewards. So you have to have the mindset that that the field will evolve, right? It will never stay static. The regulations will evolve, the technology will evolve, and things will keep on evolving, and you have to be on top of the evolution that is happening. There is a lot of random noise in the market, right? There are millions of people who are trading, right? So there is so much noise out there, right? Not everybody is doing the best thing. So you have to make sure that you don't get boggled by all the noise. You have to have a mindset that can filter out the noise. The risk management that you do will be most important thing, part of the whole process. And obviously there can be black swan events, right? So in finance, there are, everything goes fine until one day there is a crazy crash, which might be due to a number of reasons. And these black swan events do happen. So whenever you are modeling or creating a model, you have to make sure that you account for that your distribution is not normally distributed. There are some very crazy tail events that can happen that can, screw up the models. You have to always make sure that, you have something take care of that. There is a low scope of errors when you're doing this, right? Because, actually working with money, with other people money. So there is the scope of error has to be a little bit low. There are a number of complex interaction between various things in the market. And it's a mix of, the age-old knowledge in finance and any new technology that you're using. It's a very interesting problem to work with, if you like working on real-world problem with data science. And there's a lot of scope for you to innovate in this particular field, right? So this is, this is what, if you want to go into the field of quant finance, it will look like. There are a number of roles here, right? So there are so many banks, investment advisories, brokers, various intermediaries that have, very, very interesting roles out there in the field of quant finance. And people who are passionate about, working with this field, who sort of understand that, it's a noisy field. It goes through its cyclical phases, but in the long term, it's a very, very, attractive thing. Will really flourish when you do this. Now I can quickly go through a presentation on algorithmic trading that I sort of do when I'm doing an introduction to algo trading with students. So in this particular session, what we'll do is we'll talk a little bit about what is algorithmic trading, what are the forms of algorithmic trading, and what are the popular algorithmic trading strategies that people apply when they are doing this, right? So what is algorithmic trading? Algorithmic trading is nothing but a set of instructions or rules that will lead to a trade, right? And what are the types of instructions that you give out? They will be in terms of the timing, price, quantity, right? That take this trade now, buy this now, buy this many shares of this particular instrument right now, right? So that is what algorithmic trading system gives out. And so one part of algorithmic trading is obviously there are hedge funds, there are prop funds, there are various people who are trying to generate profit out of the market, right? That I will create an algo that consistently generates profit for me. Right? So that is one part. But secondly, algorithmic trading using algorithm also makes the market very, very liquid. And when you act in a systematic way, you reduce the impact of human emotions, right? So So let's suppose there is a large order that a mutual fund needs to execute, right? They want to buy, let's say, 100 crore worth of Reliance share, right? Because earning has come and it's looking exciting right now. And so they can't push out a single order. They obviously have to slice and dice it and, place that order in a much more organized fashion. So an algorithm also does jobs like those, right? That they make life easy for, or, save the cost, save the impact for the traders out there. Also, talking about, when you act with an algorithm, you reduce biases, right? You act systematically. You have defined, you have back tested on a lot of data, and now you have well defined rules. So there is a low scope of, your emotion, like, I like this stock or I dislike this stock, sort of impacting your decision making. And always, going with a systematic fashion uh, tends to be, if you have a good model, tends to be better than acting emotionally in the market, right? Because it is very, very easy for us to be biased by our emotions when we are, out there in the market. Let's talk about the history of algorithmic trading in India, right? So like I said, algorithmic trading in India actually, 2008, the DMA facility was introduced, right? That institution can now directly access the market. But in 2010, the co-location server, right, the biggest part of the puzzle, which is where, these high frequency traders sit, that started, and that is when, a lot of these large foreign banks and large investment banks in India like Edelweiss, etc., they started setting up their desks uh, to do the algorithmic trading functions in India, right? So I was fortunate enough to work with one of the desks in 2011-12, right, and till 2016. So I saw the chart of like this right now. It shows you that that algorithmic trading forms 40% of all trading in the market, and 60% of it is manual. When you're looking at cash trading, right? When you're looking at trading only in stocks, not in future and options. So when you're looking only in stocks, only 40% of this piece is what algos are doing. This is a slightly old data. When you look at the current data, you would see that maybe we have now moved more than 50-60%. But when I used to work in algorithmic trading group, then algos actually used to form to be less than 20% of the overall volume, right? So it has been a very interesting place where people have found that an algo is actually saving me the cost, it's actually giving me a good price, and it is actually making my life easier. And that's how algorithmic trading is now becoming a huge part of the Indian market. And if you go to any of the larger brokerage houses and institutions, you will see that all of them have their algorithmic trading setups which they use uh, for enabling their trading. And what are the benefits that algorithmic trading is bringing to the people is that obviously the scope of manual error goes away, right? If a human being is punching multiple orders, there is a chance that something might go wrong. But an algorithm sort of repeatedly does the same thing that it is assigned to without making many errors. And when you're doing algorithmic trading, I think the best thing is that you can backtest, right? I cannot backtest myself, right? That I'm a good trader over 10 years. I have to actually be in the market for 10 years to have that confidence that, okay, I act well in the market, right? But if you want to build a system and backtest it over, rigorously backtest it over historical data, you can be fairly confident that, okay, this will do well in the market. And obviously you have to watch it and see it live as well. But algorithmic trading, the backtesting form in the algorithmic trading market gives you uh, much more confidence to do well in the market. The possibility of mistakes that human traders make because of their emotions and biases, right? Many times what might happen is that, even though you can see that something is going wrong with a particular stock, you are emotional about it and you don't sell it, right? You say, okay, no, I want to stick to it because I bought it and I want I'm biased towards it, things like that. Or, even if you see that the market has run up too high, you're saying that I'm going to enter at the top because, I believe that it is going to keep going up and up. Whereas if you act with an algorithmic fashion, you can have checks and balances that, reduce that emotional behavior, and that improves your trading. When you're doing algo trading, then, your order placement will be instant and accurate. You can get better prices than manual trading. And it is obviously much more quicker, right? And a system can interact with other system in a much faster fashion. Whereas when you are punching order as a human being, you might take a little bit more time. You can save in terms of transaction cost by, and impact cost by slicing your orders. And you can put simultaneous sort of checks and balances for market conditions when you're doing algorithmic trading. So now talking about the forms of algorithmic trading, right? Like, I mean, it is interesting. Like, you can say that, okay, I want to do algorithmic trading, but what exactly will you do when you start doing this, right? Talking about the forms of algorithmic trading, it happens in 3 major forms, and then again into 3 major frequencies, right? When we talk about frequencies, what I mean is that there are some people who actually execute trades within microseconds, right? So those are high frequency traders. They are trying to capture mispricing in the market, which lasts only for microseconds to milliseconds. Those are high frequency traders. There are mid frequency traders who are looking at opportunities that might last minutes to hours to even days, right? So these are mid frequency traders. And then there are low frequency traders that are looking at 1 month, 1 year, or 6 months, larger horizons for their trading. So you can do algorithmic trading in either of these fashions, and if you're applying an algorithm, it is algorithmic trading, but the frequency of it will vary, right? What are the forms of algorithmic trading? Again, you can so the majority of algorithmic trading, right, in the chart that I showed of 40%, a majority of it happens for execution, right? So like I said, that large pension fund, mutual funds, etc., they want to buy a huge quantity of stock, so they can't buy it with a single order, or they have to slice and dice it to get the best price, right? So they apply algorithms to achieve those things, right? So that is execution function, which is a very, very important part of the whole trading process, that makes the market liquid, that gives a good pricing, that reduces impact in the market. So that is one part. Second part is arbitrage, right? So there's a huge number of people who actually look at prices of 2 instruments, right? Let's suppose they look at the price of a particular stock on NSE and BSE, right? On both the exchanges, the stock price should be the same, right? But if the price is different, right? If the stock is being sold at 100 rupees at NSE and it is being sold at 110 rupees at BSE, right? So what I will do is I will buy it on NSE, I'll sell it at BSE, and I'll just immediately make that 10 rupees profit, right? So things like that, which are very quick actions that will give you short profits. So there's a huge number of people who do pure arbitrage. They look at various other mispricing. So NSE BSE is a very simple thing, but they're looking at mispricing between a cash instrument and future. They're looking at mispricing between option structures. They're looking at currency arbitrage, a number of things, right? And these guys, when they're trying to capture this mispricing, this short mispricing, they're also making the market liquid, right? So, I mean, in an ideal market, there should not be a mispricing of 100 and 110 rupees between 2 exchanges. They should all be at a similar price, right? So an arbitrager is actually reducing that friction. It is enabling a better flow of information across the market. And that forms a huge chunk of algorithmic trading. And then the third is the systematic traders, right? So all the retail traders who are running their own algorithms, or hedge funds, CTAs, trend followers, etc., who are creating algorithms to profit from the market, right? So to generate profit from the market systematically, and they might have a number of theses on which they will work, and we'll cover that in the later portions of the session, right? So this is the third type of function in algorithmic trading. So when if you are looking at a career in algorithmic trading, pure play in algorithmic trading, you would either be in an execution function or arbitrage function or a systematic trading function. And then again, there are a number of things that happen here, right? You can be in tech, you can be in data science, you can be in structuring, you can be in sales, etc. So there are a number of things that you can do. Talking about the types of strategies that are out there that people actually use when they are in the market. So the one most important thing or a widely used strategy is trend following, right? Almost 50% of the people, they look at trends in the market. They look at they believe that the market knows best, right? When the market is showing a trend happening in a particular stock or instrument, that is a opportunity to buy into it, right? Because the age-old belief is that the stock prices are governed by the fundamentals, right? If the company is releasing a good report or a good number, they've shown that I have done so much profit growth, that is when the price should actually go up, right? That is when its valuation is going up. So theoretically, that is what should happen. But actually in markets, like I said, people are not rational. There is so many irrational biases that govern the market that not everybody would buy that stock right now. When the valuation has changed, people take their time, they evaluate, and when critical number of people come join that trend, that's when the trend happens, right? So that is I think a very so this type of strategy is very widely used, where people are trying to capture these trends in various frequencies, not just long-term trends, but even on small horizons, or even on hourly basis or minutely basis, or even smaller time horizons. So this is one of the main things that happens when you're doing when you're exploring a type of strategy. I think the most popular one that you will see is trend following. Second type of strategy is something that I like to explore, is not that any stocks, how do you get an outperformance from the market? One thing that you can do is trend following. But otherwise, if you sort of listen to the market commentary or analysts out there, you will see that some people, they do let's say quality investing. They try to find out a best quality stock and invest into it. Second, there are people who might look at value stocks, right? Any stock that is undervalued compared to its price, they invest into that, right? We talked about trend following or momentum, which is investing into trending stocks. Then there is people who look at volatility of the prices. Any stock that has a low volatility, they would invest into that because they think that low volatility will give them consistent returns, right? So there are all these smart strategies, right? So like when you look at the market, there's a Nifty and a Sensex, right? Which are just market cap weighted top 50 stocks, right? Top 50 largest stocks in the economy. But when you look at these smart strategies, right? Like I said, momentum, quality, liquidity, etc. These will give you a little bit of a better performance compared to the market that you can use to create a diversified portfolio. So that is also a lot of investors are doing smart beta when they are doing their investing. Now talking about the third type of strategy. Third type of strategy is mean reversion, right? So one thing that people like to do is, okay, there's a trend, let's capture it. Second thing is that people believe that any stock price would, maybe go around its long-term moving average. Right? So it will revert to its moving average. If it has gone too high above its 20-day moving average, let's say, it is going to come down and match the moving average eventually, right? That is one thing. Second thing is, let's say, the price difference between two instruments, let's say Nifty and Bank Nifty, they should be in a certain the average is a certain number, right? And if the mispricing has widened to a huge margin, then people expect they should mean revert and eventually come down. So mean reversion is a very interesting strategy where there's a lot of quantitative work that is applied. You have to look at seasonality of the particular thing that you're trying to capture and form your models around it. But it is also a very, very widely used technique in algorithmic trading that works well in range bound markets, when there is not too much, when you don't have a massive trend going on. And it's a very interesting strategy to work on when you're doing algorithmic trading. The other type of strategy that I already talked to you about is the arbitrage strategy, right? That you have found out that there is a pair of securities that should theoretically be priced equal, right, or with a certain spread, and suddenly because of the supply and demand in the market, the prices had diverged, and they have to come back because that is the nature of these two instruments, right? So let's suppose there's a stock and its futures, right? They have to only be at a certain spread based on what the how much time is there for the future to expire. But suddenly, if the future is selling at a very, very high price compared to the stock, then you can easily say they are going to converge, right? In a few days, they have to converge to the same price. So you can sell one and buy one and try to capture that spread and make a small amount of profit. Is a widely used technique. Not only is it legal, right? Is not what you're supposed to do, but it is very, very legal and it is very, very useful for the market. Like I said, it increases liquidity in the market, it increases efficiency in the market, it reduces the impact in the market, right? You don't want, if two instruments are created to be theoretically at a certain spread and they are not behaving, they're not suddenly they have a mispricing, then then the markets are not doing their function, right? Then the markets are not being efficient. So the arbitrages out there, they reduce those inefficiencies and make the market very, very efficient. Another set of strategy that people, and this is especially used by high frequency traders, what they do is what they call is market making, right? So they try to make a small markup between the price. So they actually do buy and sell both on the same instrument, right? So they are not biased towards buying that or selling it. They try to capture small spreads by buying and selling at different times based on the order book and the volatility in the particular stock, and by capturing these small spreads by doing their market making, these guys make consistent profit, which makes high frequency traders very, very profitable. So market making is a very interesting strategy that a lot of high frequency traders do. So that is about all the strategies that you will see out there in the market. I'll briefly talk about the type of strategies that I run right now, right? So at Wright Research, we do a lot of very interesting strategies, right? So most of them are investing strategies, slightly low frequency algos. So here we look at a number of factors in the market, like the trend following factor, the value factor, the quality factor, the growth factor, and all into high quality stocks, right? The first thing I would have to do is, how do I say that this stock is high quality? What defines quality, right? So you do a little bit of research before I find out that any stock that has a good return on earning, right, ROE, or return on capital employed, ROCE, or there are a number of other ratios that you can actually explore, and then you rank the stocks based on those ratios. You have a universe of, let's say, 500 stocks. You rank the stocks based on those ratios. You select the top stocks that have that particular ratio and you invest with them. Or instead of selecting the top ones, you can use a portfolio optimization algorithm. There's a very interesting field of work which is portfolio optimization, where you try to maximize your return but minimize your risk, reduce your cost, and come up with an allocation that you take out So we do this for a number of factors, and we create our portfolios that have been performing really well in this market over the last 3 years. We also do a lot of alternative products, right? So we have our statistical arbitrage strategy, where we're looking at, going long and short, both. We look at mispricing, right? Short-term mispricing between the price of various stocks, and we take long-short positions, and we call that statistical arbitrage. We have option buying strategies, where we're looking at short-term index momentum and buying options based on that. And we have option selling strategy, where we're betting on theta decay and shorting the gamma to make a consistent profit. So we look at all these interesting strategies. We also do US-based investing, and we are exploring a number of other products that we want to create and want to give out to our clients. Right? So that is broadly it. That is what I sort of wanted to cover here. We also do, like at Wright Research, we do a lot of interesting research projects also. So not only do we apply not only do we have systems that create all these strategies and portfolios, but we also do incremental research on topics like reinforcement learning in finance. How can you apply machine learning and reinforcement learning in finance? How can you improve the performance of deep learning models? How do what works as deep learning or gradient boosting? A lot of interesting stuff where we collaborate with other universities and other students on creating these interesting research papers. So you guys can definitely reach out to us. You can definitely follow us on social media, and reach out to us if you want to know anything more about what we are doing, or you want to look at exploring and working with us in any of the research areas. Feel free to contact us. Now I think I've been talking for a very long time, and we can probably take a few questions from the audience.
Yeah. So guys, if you want an internship with Sonam, ask the question. Yeah. Anshuman, well, you're so you get the first.
Good afternoon. Ma'am, you said that hello, there are various kind of trading strategies such as medium frequency trading or high frequency trading. Is it common for companies or traders to specialize in both, or they usually focus on one aspect, like a particular company is more focused on high frequency, others for low frequency?
Yeah. So people usually focus on one type of thing, right? There are, so majority of funds in India are frequency traders, right? And then you have medium frequency is evolving right now. So a lot of people are trying to do medium frequency, and then low frequency is obviously a wide area where quant is again trading. But usually, because the whole dynamics of the market are very different in the long term, in the short term, and in the very short term, right? So people will probably focus on one thing instead of all of it.
Thank you, ma'am.
Yeah.
Hello, ma'am. So you said that there are black swan events. So when such events happen, how responsive is the algorithm to it? Like for humans, it's much easier to tell that something has happened, so this might happen. But algorithms usually train for a long time.
Yeah, so I think, see, it is also, so I mean, as a quant, you are the one who is building the algorithm, right? So you have to make sure that your algorithm is responsive towards it, right? So and you have to make sure that when you are modeling this any particular algorithm, that there will be a scenario where your thesis will sort of break because the market has gone through a very crazy short-term event, right? So you should have risk checks in place, right? That I think we've seen events like the flash crash in the market, right? Where the algorithms, they saw the prices going down and all of them just jumped into it and they exacerbated the whole price move. So when you're creating an algorithm, you have to make sure that you understand when the your thesis is broken and you stop participating, right? Or you reduce your risk, right? So like we run an algorithm which does asset allocation, right? Which allocates between equities and bonds, right? So when the March 2020 crash had happened, the algorithm itself, even prior to the crash, it saw that the risk in the market was high. So it had reduced exposure to equities, it had increased exposure to bonds, right? And when the crash, the drawdown started to happen quickly, we saw that we were able to reallocate from equities and reduce the drawdown for our clients. So when you are building, you have to basically make sure. See, in finance, things like these can happen, not very frequently, but they will happen in the long run. So when you are creating an algorithm, you have to make sure that you are accounting for these.
So for example, if you have algorithms that work well in certain scenarios, can we combine them? Like, can the model switch between algorithms? Seeing the market.
So I think a lot of funds, they do this, that they create a number of algorithms that that work well in different scenarios, right? And the final portfolio is a collection of these algorithms. Either they keep them running, all of them running at the same. Do is that they only run some algos at some point, and they tactically allocate to those algorithms.
Hello, are we there?
Yes, sir.
Hello.
Yeah, Kaustav, go ahead.
Yes, ma'am. Thank you. Like, it's all my question.
Okay. So, Sonam, there's one question that I had for you. There are a lot of, girls in this class, and unfortunately, they've been fairly quiet. And I know that even the terms alpha and beta are more misogenic, and so first of all, kudos to you that in such a world you have emerged tops. Okay. But what is your experience and what would be your message to the girls in this class?
Yeah, I think, see, I mean, obviously we need more girls to actually come into the field, because I have hardly ever had any female colleagues whenever I've worked in controls. There's a huge need to be in this field, and there's no, there is nothing that stops you from doing well in this field if you are able to, do well in terms of the data science and in terms of your financial knowledge and how you're applying it. It doesn't differentiate between a man or a woman, and so whatever females you will see working in this field, they are able to do much more consistent work, inherently conservative. They make sure that they cover the mindset of, I think, women working in this field can take them to far of places. So I mean, you can take me as an example. I really like this, and I pursued it. There hasn't been any, being a woman, right? Sometimes a client might question you that, I don't see too many women and you are here. But I've seen more people appreciating me, like Raghu just said, that he appreciates that women is trying to do something. So a lot more people appreciate women doing this work than not.
So any of the girls want to ask Sonam a question?
Excuse me? Yeah.
No, I'm asking the students. Any of the girls want to ask you a question?
Yeah.
So they've been stagedly quiet. Of course, the boys can also ask a question.
Ma'am, what are the opportunities for fresher like us in this field as of now?
Yeah, see, I think there are so many opportunities out. There are so many forms of algorithmic trading, right? There is institutional execution, there is arbitrage, there is systematic trading, and there are so many players, brokers, advisors, mutual funds. There's so many roles, right, where you can explore. And I think what when you are applying as a fresher, what a hiring manager would appreciate is that you have a little bit of a basic knowledge and a passion to work in this field, right? You know technology, but you don't want to apply it in finance, right? So people will not appreciate it. So you try to have, build a little bit of a knowledge of the market and hone your programming skills, and that would be really encourage somebody to bring you on into the field, because people who are passionate in the field tend to survive in the long term.
Yeah, so you apply for an internship. Yeah, with Wright
Thank you,
Research.
ma'am.
Yeah.
So any other questions, guys? We still have some time. She can take a couple more.
Hello, ma'am.
Ma'am, and how are you doing?
Hi, I'm doing well.
Yeah, go ahead.
Yeah.
Okay.
So
Ma'am, in high frequency trading, there are
Yeah.
scenarios where the algorithm makes a wrong trend, for example, and because of high frequency, like there are the losses are huge basically, and it also creates a trend in the market. So how
Right.
do algorithms count?
Yeah. So see, high frequency trading, it is I think people tend to think that algos are causing crashes and algos are increasing the intensity of the crash. Research papers where people have analyzed that if a flash crash happened, how much of it was because of an algorithm and how much of it was because of manual traders doing panic selling. They've seen that it was more because of manual traders, right? So whereas algorithmic trading traders, there's some people who are actually trying to take advantage or do a little bit of manipulation, right? That is still there, and there are actions. But it is, I think it is wrong to assume that algo cause any particular crash. It is always a mix of a number of things, and the larger algorithms at the larger institutions, they have so many risk checks that it is very difficult for an algorithm to actually do this.
Okay, ma'am.
ma'am. Yeah. So I had a question. So in this course we have learned a lot of things. One of them being a certain technicals and looking at the candlestick patterns and stuff.
Yeah.
So my question is like, if like I have read this somewhere that institutional traders, they most often they are when they are in the market with such a huge corpus, they are more often than not looking for liquidity uh, than uh, than just basic price movements. So
Right.
since yeah, so how true is that? Like because I have also seen that technicals more often than not tend to work. So if they
Yeah.
are working, that must mean that people are going by them. But then there is
Right.
also this thing about liquidity. So
Right. See, so
yeah,
liquidity, see, where it is important is that uh, to buy and there are no sellers, right? Then you will not get the best price, right? Like let's suppose you found an opportunity, right? And you want to buy the stock, but there is nobody out there to sell it, or if they're selling it to you at a high price, then you will get a bad experience, right? So it is always,
yeah,
so
yeah,
what people, whatever large institutions do, they only do it for liquid instruments, right? So, but in India, see, Indian market is huge, right? So there are 200 or 400-500 stocks that have sufficient liquidity for you to apply any sort of model, right? Any sort of trend model or technical model, right? They are fairly liquid. But there are obviously a lot of illiquid stocks which institutions will not touch, right? If there is a stock that only has very small volume on a day-to-day basis, then you will see that any large fund is not touching it because they cannot get a good price. And you have to use it for liquid stocks.
Okay, so so when the when the institutions are working on the indices, like Bank Nifty is like the most heavily traded index in Asia. So
yeah.
For example, if we take the case of that, when institutions are working on that, is it just purely like from a hedging point of view, like they have got a lot of banking stocks and they are trying to hedge their positions, or are they just doing stuff on it independently?
See, a lot of it is hedging also, right? So you can assume that maybe 30-40% is hedging, but rest, I mean, everybody is trying to speculate on Bank Nifty, right? Bank Nifty is such a, so on the weekly expiry, there's so many people who are, betting on the theta decay. There's so many people strategies in Bank Nifty. It's a highly liquid thing, right? And why is it so liquid is because, there's so many people who are exploring strategies on that particular index. So hedging itself forms a very, very small portion actually, but a lot of it actually comes from people taking directional bets or actually speculating with this.
Okay, thank you, ma'am.
Yeah.
Any questions, guys? So, any questions from the girls in the audience? No. Okay, that's not too good, but then anyway, if today is not the day you want to ask questions, I guess we'll let it pass. So, so I had one question with which we can end. So you are the younger generation, and you have been born into technology, whereas for me, technology came in the middle of my life. I took my degree in '82, and I started working with computers only later. So where do you see, and also there's this entire movement where today there's a lot of fund houses which have these funds. So some people say with the work being done like you, there is a lot of disintermediation that is going to happen, and models like yours will become the norm rather than just the exception. So where do you see the entire future going? Because you obviously have invested and you're smart. So it's not you're not you have invested, venture capitalists have invested behind you, which means you're in it for the next 10 years. So let us say when you are into your Series D or you have become a big company, how do you see the industry changing? The quant industry.
The industry, yeah. So the industry, it has been, slowly changing, and there has been a resistance of, adopting towards algorithm initially, but now, a lot of people, they are understanding the credit of such models, right? The benefits that models are bringing. And if you with the Americas and Europe, you will see that in US and Europe, the penetration of algos is massively higher, right? So at least 20 to 30% of actual funds are quant and algo driven, whereas quant models are used in a much bigger fashion by even traditional funds. So I think that change is going to happen. It is going to happen some years where we will also, I mean, it is happening now, but there's a lot of scope of it getting much more bigger. And I think people who enter into this field right now, right, with this skill set, will see a lot of growth and a lot of interesting stuff happening. So yeah, I mean, financial markets and investment markets, they are are transformation, and in the next 5-10 years, it will be very interesting for people with quant background to come into the market and become the leaders of the next.
Okay. So I think we are correctly on the dot of 3. So Akshay, would you like to close?
Yes. First of all, I thank Sonam for the talk, and given a brief insight on the future of this particular domain. I think most of the students would be motivated by you and would be definitely seeking the career in this particular domain. Raghu sir, thank you for arranging this particular talk. And last but not the least, I thank my students for the participation and the other invitees who have participated in the talk. Thank you, one and all.
And so ever in Mangalore, you are welcome to come to. There's a lot of good food, and we should give you a lot of good food. Thank you very much.
Thank you.
Bye.